Welcome to This Explainer. Today, we're acting as your financial anchor to cut right through the noise and unpack the week's incredibly complex market dynamics. We are looking at a really rare environment right now, one where intense macroeconomic pressures are colliding head-on with the biggest technological build-out of our generation. Here is our roadmap for today. We're going to cover the stagflation threat, the AI CapEx super cycle, the sharp divide in tech earnings, global threats facing semiconductors, and finally, the bottom line for investors.
Kicking things off with Section 1, the stagflation threat returns, fueled by Fed decisions and rising energy costs. To really grasp the macro picture, all eyes have to be on the Fed. The Federal Open Market Committee just held the federal funds rate steady at 3.5 to 3.75% for a fifth consecutive meeting. But don't let that pause fool you for a second. Beneath the surface, the ground is definitely shifting. The real story here is the rare 9-3 vote. This reveals the most unified hawkish dissent, meaning a real push for tighter monetary policy since September 2016. 3 regional presidents actively pushed for a rate hike. That sends a very clear signal that the committee is far from unanimously dovish on inflation. Chair Wash actually framed this split as a good family fight, and he made sure to reiterate that there is absolutely no soft inflation target. And, a family fight at the Fed usually means higher borrowing costs for everyone else. Markets read this as a genuine division, triggering an immediate higher-for-longer repricing that pushed yields straight up into month-end. Now, compounding that rate repricing is the energy sector. Global oil benchmarks just surged, with WTI crude hitting $87 and Brent knocking on the door of $90. This is largely driven by renewed geopolitical tensions in the Strait of Hormuz. And obviously, that kind of spike disrupts supply chains everywhere. When you combine firm Fed policy with higher oil, well, that's your textbook recipe for stagflation. Moving right along to Section 2, the AI CapEx super cycle and this massive infrastructure build-out. While the macro environment is tightening up, tech spending is doing the exact opposite. The major tech hyperscalers, those giants running the world's largest data centers, are now guiding to a staggering $720 to $745 billion in 2026 AI capital expenditures. To put that into perspective for you, that single-year tech spend is literally larger than the entire GDP of many developed nations. This colossal figure confirms one undeniable fact. The AI super cycle isn't just some white paper theory anymore. It is a heavily funded reality. Regardless of the economic headwinds we just discussed, the foundational build-out of artificial intelligence is just plowing straight ahead. Which brings us to Section 3, tech earnings. We're seeing a sharp divide here as investors demand proof of monetization. We saw crazy sharp bifurcation in the market this week. It's essentially a tale of two markets right now. Equity investors actively rewarded companies showing clear AI revenue acceleration. Those are our winners. On the flip side, they ruthlessly punish the losers, companies with massive CapEx expansion but zero visible near-term payoff. It is a strict dividing line between platforms showing the best performance at the lowest cost versus those just going for pure scale. Looking at the winning side, Microsoft surged about 15% after an absolute blowout quarter. Their Azure cloud business grew 43% year over year, which really proves their massive spending is already generating real cash. Amazon followed suit, jumping up 11 to 15%. Investors clearly rewarded their strong execution, showing they have a very clear path to monetizing their own $220 billion CapEx hike. But wow, the market was far less forgiving on the other side of the aisle. Meta fell 9% as soft revenue completely overshadowed their AI dreams, while Apple dropped nearly 8%, mainly on chip supply constraints. But the biggest shocker was Alphabet. They dropped 7% in their worst day in over a year. Even though they lifted their CapEx budgets, they actually reported their first negative free cash flow since their 2004 IPO. Basically, they spent more cash than they brought in, and the market aggressively penalized them for it. Next up is Section 4, Semiconductors face global threats, and we'll look at some ecosystem vulnerabilities. This week, the semiconductor complex, which is really the physical backbone of all this AI, faced some severe pressure. Investors are starting to seriously question the integrity of the demand. They are specifically zeroing in on what are called circular deals. These are setups where AI ecosystem companies essentially invest in each other just to buy hardware. The big fear here is that this might be a tech version of borrowing from Peter to pay Paul, potentially artificially inflating real end-user demand figures. Looking purely neutrally at the math and logistics, the chip supply chain is facing a formidable triple threat.
First, reports indicate Chinese state-backed companies are mass-producing their own DUV lithography machines. Those are the super complex machines used to print chips, so that's massive new competition. Second, geopolitical tensions are peaking, with China drawing a red line against 20 to 30% U.S. tariffs ahead of a Trump-C meeting. And finally, AI-driven component cost inflation is just squeezing hardware margins right across the board. Finally, Section 5, the bottom line for investors. Let's talk about the timing and quality of returns. So what does this collision of macro stagflation and a divided AI boom actually mean for you? Here is your action plan. Step 1, you have to acknowledge this sticky stagflation environment. With a divided Fed and rising oil, a soft landing is definitely not guaranteed. Step 2, recognize the massive, undeniable scale of the AI supercycle. But critically, Step 3, pivot your focus. Capital is no longer rewarding pure size. It is rotating strictly toward platforms that can demonstrate real, near-term revenue against a highly volatile economic backdrop. The era of rewarding pure CapEx expansion without a clear payback, yeah, that is over. The market is strictly demanding profits over promises right now. So I will leave you with this vital question to consider for your own exposure. As the market demands profits over promises, is your portfolio really prepared for the actual mathematical reality of the AI supercycle? Thanks so much for joining me for this explainer, and definitely keep these dynamics in mind as you navigate the markets this week.